Hello, Kurt Jackson with KJ Financial here again. We are in our second module of our Retirement Accelerator Blueprint, where we're discussing the 10 biggest risks that you face in retirement. And risk number 3 is called withdrawal rate risk. So what is withdrawal rate risk? It's when we need to determine how much money you're going to need on top of your sources of guaranteed lifetime income, typically Social Security and maybe a pension if you have one, for you to live the lifestyle that you want to live for as long as you, and if you're married, your spouse live, no matter how long that is. So one of the biggest challenges with withdrawal rate risk is compounded by all the other 9 retirement risks. So why is that? Well, since we're trying to determine how much income you're going to need to get from your retirement nest egg on a monthly or annual basis, we need to be concerned with how long you're going to live. Will market risk be a problem? Could the sequence of returns you experience in retirement cause issues? How much income taxes will your income create? How much will your income need to grow annually to keep up with inflation? How much will be enough to cover your healthcare costs? How much will any potential long-term care costs be? Will your assets suffer deflation risk? Could regulatory risk increase taxes or other costs in retirement? So can you see why there's a lot riding on your withdrawal rate? So keep in mind, optimizing Social Security certainly helps with making this risk a little bit lower, which is why it is an important focus in the Retirement Accelerator Blueprint. So anytime you can efficiently create guaranteed lifetime income, it takes pressure off withdrawal rate risk. So following traditional planning's idea of a 60% stock, 40% bond mix, withdrawing 4% a year adjusted up with inflation, it never really worked as promised. Is that any surprise there with all the things we've taught you so far in our series here? So even back in the early 90s, when interest rates were considerably higher and inflation was much lower, the 4% rule failed roughly between 18 to 30% of the time. So would you be okay living your retirement with an 18 to 30% chance of outliving your money? More recent research has shown that failure rate on a 30-year retirement period to be well north of 50%. Would that much risk of outliving your money be acceptable in your retirement plan? So could you see why it would fail that much? I mean, do you recall the inefficiencies of the market with inconsistent returns? The huge impact market losses have on your ability to build wealth. The devastating impact that compounding losses of those guaranteed annual losses created by paying fees. Do you remember how much more efficiently our alternative financial vehicle was able to build wealth in good sequence of returns and a okay sequence of returns and a bad sequence of returns? Do you think that type of safe and productive growth strategy and aggressively safe investment could also provide you with more income in retirement? Let's run a quick hypothetical scenario. So hypothetically, let's assume you're 65 with $1 million in your retirement nest egg, invested in the S&P 500 with dividends, paying 1.5% in fees, and with a 3% inflation rate, utilizing traditional planning's 4% rule adjusted up annually for inflation. If we use the good sequence of returns beginning in 1998 through the end of 2022, in the market, you'd have received $1,458,371 in income through age 89 and still had $501,777 left over. So why did we stop at age 89? Well, our example was only good for 25 years, right? That was what we had. So we went 25 years and had to stop. All in all, it's a pretty good market-based scenario, right? You started with 40 grand a year in income. At age 89, the income had grown to $81,312, so it more than doubled because remember our inflation rate was 3, so about 24 years. So in the 25th year, it's above 80,000, right? So hopefully keeping up with inflation, and it had some more years left in it. That's all good. So how would that compare to our alternative? So remember, it was linked to the S&P 500, not in the S&P 500, without dividends, grabbing annual gains up to 13%. Never losing when the market was down, and no annual fees. So our alternative safe and productive growth strategy would have created the same $1,458,371 of income through the age of 89, plus you would have still had $2,129,545 in your account. Isn't that a whopping $1,691,823 more than the traditional market example during a good sequence of returns? So how about if we look at an okay sequence of returns? Everything is the same except we began on January 1st, 1999, assuming the same alternative situation. Traditional planning model would have run out of money at age 87, basically about 4 months into age 87, providing a total of $1,260,897 in retirement income. Quick analysis, going from 2 good years before 3 years of losses to 1 good year before 3 years of losses means you ran out of money at age 87 in about 4 months versus having income through age 89 with having $501,777 left over. Remember, this is what we call the sequence of return risk, right? So our alternative safe and productive growth strategy provided a total of $1,298,115 in retirement income because it went all the way through age 87. You still had $1,857,595 in retirement nest egg. So obviously you could have gone on for many, many more years. And remember, we started with $1 million. You took out almost $1.3 million in income, and we still had $1.857 million left. All in all, a really good situation. But isn't that a full $1,943,897 more than the market-based example? So how about the bad sequence of returns beginning January 1st, 2000? That was right as the dot-com crash hits, assuming the same parameters as in the previous two examples. You would have run out of money with about 1 month left of your age 82, almost 18 years, receiving $961,114 in retirement income. So didn't things get ugly quickly in that scenario compared to the other two? But wait a minute. Didn't you start with $1 million? Doesn't that mean in the bad sequence of returns, you didn't even get back all the money you started with? Is that how retirement income planning is supposed to work? Well, how did our alternative fare? It provided $1,262 in total income all the way through age 82 and still had $1,265,103 remaining. So isn't that a full $1,306,251 more than traditional planning? So you had over $1 million in income. You still have $1.2 million left after age 82 in a bad sequence of returns. So which plan performed the best in a good sequence of returns? Which plan performed the best in an okay sequence of returns? Which plan performed the best in a bad sequence of returns? Since we can't pick which sequence of returns we're going to get in retirement, which plan would you have rather been in to handle whichever of these hypothetical situations you ended up with? So in the alternative plans, could there have been enough extra money to provide income if you lived longer? Could there have been enough extra money if taxes were higher? Could there have been enough extra money if inflation was higher? Could there have been enough extra money if your healthcare costs were higher? Could there have been enough extra money if you needed long-term care? Is there a definitive answer to any of those questions? Isn't that the challenge with retirement planning? We don't have definitive answers, so we have to plan for the possibility of those things. Which option would have given you a better chance to handle any or maybe all of those potential risks? Which plan would have given you more peace of mind? And isn't peace of mind what retirement planning is all about? No sleepless nights worried about money? Please understand, we're not saying safe and productive growth will always give you the income you need to handle all life gives you. Do you think it looks to give you a significantly better chance of minimizing withdrawal rate risk than traditional planning? So our fourth risk is one you've become more familiar with, but go ahead and click on the video below to quickly readdress sequence of return risk.